We shall commence this module by discussing about liquidity crisis. Generally, the term liquidity refers to the availability of cash with an individual or an organization to meet their current or short-term obligations, or how quickly they can convert their assets into cash. The last few decades have witnessed tremendous growth of the international capital movement. With globalization and liberalization, countries have become more and more financially interdependent. Increased capital mobility has brought many benefits for the participating countries, but at the same time, it has exposed them to increased financial fragility. The recent 2008-9 financial crisis is a prime example of this fragility or fragile nature of finance, being the most severe crisis since the Great Depression of the 1930s, as it resulted in the worldwide economic downturn. As the financial markets have grown more complex and at times difficult to regulate, we can see that numerous countries such as USA, Great Britain, Japan, etc. have grown more prone to financial turmoil and macroeconomic problems. The East Asian crisis of 1997 and the recent financial crisis hold a prime position in discussions of the liquidity crisis. Let us understand the anatomy of these crises. After studying this module, you shall be able to know about the financial crisis faced by the East Asian and US economy and identify the factors behind these two crises. Let us discuss the East Asian crisis. The East Asian crisis was the sharpest financial crisis that hit the developing economies and came as a surprise to many observers of the East Asian economic regions. The East Asian crisis was the sharpest financial crisis that hit the developing economies and came as a surprise to many observers, as the East Asian economic region was growing tremendously during the 1990s. Capital inflows increased from an average of 1.4% of GDP between 1986 to 90 to 6.7% between 1990 to 96. In Thailand, capital inflows averaged 10.3% of GDP between 1990 to 1996. The core of the crisis is found in large-scale capital flows, vulnerable financial markets, poor governance, and poor macroeconomic fundamentals. 5 economies, Indonesia, Korea, Malaysia, Philippines and Thailand, were hit the hardest by the crisis, and it had contagion effect on the other economies as well. Let us now discuss the onset of this crisis. The East Asian economies, especially the tiger economies, that is Hong Kong, Singapore, South Korea and Taiwan, prior to 1997 enjoyed high growth rates, high investment and saving rates, higher employment rates and unprecedented capital flows, budget surplus yet low external debt export ratios. These economies were considered successful models of economic growth with rapid pace of industrialization and liberalization. During the 1990s, the East Asian countries such as China, Hong Kong, Singapore, Republic of Korea, etc. were attracting a lot of FDI flows to their countries. These economies were offering higher interest rates compared to rates offered by many industrial economies that were witnessing a recessionary trend. As a result, the East Asian economies were an attractive investment destination and a source of arbitrage funds to take advantage of interest rate differentials among countries. By 1996, they had received the highest FDI. Regional trade had also grown ninefold during the period 1980 to 94. Moreover, Low foreign interest rates meant that domestic investors had easy access to low cost short term funds and thus they could reduce their financing costs. Therefore, there was an increase in short term bank lending to these economies. Banks had emerged as a leading source of finance, directing funds to non financial institutions. With the recession in the industrial countries, the world prices of manufactured products were falling and the tiger economies and other Asian economies that moved to more technologically advanced products gained competitiveness. Property market attracted huge investment as private savings increased, higher growth rates attracted foreign interest. Real estate loans rose along with sharp increase in property prices and equity prices of property development companies. As a result, banks became extremely vulnerable to any downturn in the property market. Rise in the rate of interest and depreciation of currency also made banks extremely vulnerable. During 1994-95, trade flow of Asian countries started to slow down as recovery gained momentum in the industrial countries that started focusing on technologically advanced products. The growth of export earnings of Asian economies dropped markedly because of the decline in import propensities of developed countries. Export earnings dropped due to fall in prices of their exports. It fell by over 20 percentage points in Thailand. In its response, the Asian economies augmented investment and ventured into new areas of production. Additionally, the entry of low-cost producers led to falling competitiveness and compounded global excess supply. This resulted in deterioration of the overall terms of trade of many countries. On one hand, the availability of low-cost financing opportunities led to the expansion capacity. However, on the other hand, the economic growth rates of the region were falling. This meant decline in the returns to investment. Next, we will discuss nature and effects of East Asian crisis. The first sign of crisis was felt in Thailand in early 1997 when Bank of Thailand adopted a floating exchange rate, resulting in massive capital outflows and financial panic as its currency fell and equity prices went down. In early May 1997, there was a sudden reversal of the dollar relative to the yen, leading to expectations of a rise in Japanese interest rates. This led to an outbreak of outflow of funds from the East Asian economies to Japan and eventually selling pressure on baht. The country ran out of foreign exchange reserves and eventually had to abandon the fixed exchange rate system. Three factors led to the downfall of Thai currency during the 1990s. First, during the 1990s, the country was running a current account deficit of about 8% of GDP. The real exchange rate increased by 17% between 1995 and 97, worsening the current account, and moreover, it had accumulated a high foreign debt. The devaluation had a major impact on banks, property developers, and businesses. It exposed them to the risk of unhedged foreign borrowings, led to an increase in baht value of foreign liabilities without any equivalent increase in value of assets, and increased the country's foreign debt payment obligations. Equity prices fell as panic spread. The firms and the banks attempted to hedge or liquidate debt by buying dollars and calling in loans, thereby increasing pressure on the exchange rate. The currency crisis in Thailand soon spread to the other countries. The Malaysian ringgit, the Indonesian rupiah, and the Philippine peso got adversely affected. Towards the end of July 1997, the peso, rupiah, and the ringgit went down. At the same time, Malaysia and Philippines were facing rising current account deficit and consequently their currencies were allowed to float. The firms were faced with tremendous pressure to survive their foreign debt and at the same time manage their falling balance sheets. By 1998, the three currencies were devalued by 30 to 40%. Indonesia faced severe macroeconomic problems with fragile economic and political environment. Soon the panic spread to the other economies of East Asia. The firms were faced with tremendous pressure to survive their foreign debt and at the same time to manage their falling balance sheets. The Korean won was devalued by 50% by the end of 1997. The South Korean economy faced a major economic crisis and required IMF and World Bank intervention to the tune of over $58 billion. Its foreign exchange reserves had dried and the banking system was on the verge of collapse. It suffered a huge lot of corporate bankruptcies. Together, these five economies witnessed huge and rapid reversal of private capital flows, drop in bank lending, and several interlocking macroeconomic and microeconomic effects. Exchange rate depreciated and domestic interest rates soared, leading to rapid rise in non-performing assets and balance sheet losses. Let us discuss the spread of this crisis to other economies. The Chinese market was not left behind. The exchange rates were under pressure and institutions soon became aware of the increasing vulnerabilities of the region. The contagion was soon felt in the Northeast Asia as investors attempted to hedge their foreign exchange exposure, thereby pushing a downward pressure on the currencies. The expectation of losses in one emerging market spread quickly to the other markets. Investors and market participants lost confidence not only on the current scenario but also about the future prospects and started hedging against future declines, thereby causing further downward pressure on the exchange rates. The crisis transmitted to other economies such as South Asia, Latin America and Brazil that witnessed huge capital outflows. While discussing the policy response, the support from IMF was aimed at maintenance of the domestic currency convertibility, ensuring free capital flows and guaranteeing payment to foreign lenders. They insisted on the adoption of restrictive fiscal and monetary policies, flexible labour markets and removal of trade barriers. The IMF programs generally called for 6 key actions: immediate bank closures, quick restoration of minimum capital adequacy standards, especially in the first Thai and Indonesian programs, tight domestic credit, high interest rates on central bank discount facilities, fiscal contraction, and non-financial sector structural changes. Various instruments such as fiscal and monetary tightening and raising the interest rates met the crisis. The policy rationales behind these measures were to restore market confidence, management of exchange rates and capital flows. They were also aimed to achieve correction of economic fundamentals, that is, to reduce payments imbalances. The fiscal restriction was imposed mainly by the government to fund expenditure for the recapitalization of the banking system. However, the policies were unsuccessful in achieving the desired results, rather it intensified the debt deflation and recession. High interest rates failed to curb the flight of capital. It has to be noted that the crisis was not the result of any problems in the current account and therefore policies aimed at a payment adjustment intensified the financial problems. It aggravated the policies of banks and property development companies as foreign debt increased. Increased interest rates further reduced the asset prices. Eventually, the interest burden as a percentage of GDP rose significantly. After witnessing a spectacular growth period, these economies were witnessing a massive economic meltdown. Growth rates were revised downward, household income had fallen, and unemployment had risen sharply, especially in export oriented, labor intensive manufacturing firms and the construction sector. These firms were instrumental in reducing poverty and increasing employment by absorbing large number of low-skilled workforce. High food prices and reduced social expenditures further fueled poverty in countries such as Indonesia. The Thai unemployment increased by 8.8% in 1998. In Asia, the regional integration was one of the factors that aggravated the crisis rather than being a protective shield in the case of isolated crisis. A popular explanation of the crisis emphasizes on the weak economic fundamentals in the form of structural and institutional shortcomings in the East Asian countries. The crisis was characterized by lax regulation and supervision of the financial system. The regulators were inefficient and inexperienced in dealing with the new financial system. Foreign investments in these markets mostly financed the property market. Financial liberalization increased the dependence of these countries on foreign resources and hence were prone to vulnerabilities. This resulted in excessive external borrowings. Thus, the currency and the equity market reacted adversely to the payments disequilibrium when the crisis hit. In addition, government intervention was marked by corruption and cronyism that further distorted incentive structures and reduced the efficiency of investment. The East Asian crisis of 1997 exposed the vulnerabilities associated with financial liberalization and dependence on financial resources and teaches us that no economy is immune from financial crisis and resultant economic problems. Moving on to discuss the financial crisis of United States of America. The US has always been a niche economy and has been a very attractive destination to the investors worldwide. It has been the pivot point explicitly after globalization and integration worldwide. It has to its credit long periods of success and prosperity. However, it has suffered economic recessions, big or small, all through its history. The National Bureau of Economic Research defines an economic recession as a significant decline in the economic activity spread across the economy, lasting more than a few months. As familiar as people in the United States are right now with an economic recession, the United States is not the only country to suffer from them. Any country that has even a remotely similar modern economic structure has suffered to some degree from an economic recession or from recessions. The sign of US financial crisis stemmed from the American housing market. The sign of US financial crisis stemmed from the American housing market. The property market witnessed a peak in 2006. However, afterwards construction activity declined and property prices fell. The housing market had dropped by more than 30% by 2008. The banks and financial institutions had extended huge amount of loans during the property market boom. Household debt in the form of subprime lending had increased manyfold over the past decade. Subprime loans refer to loans extended to borrowers who do not qualify for normal market interest rates because of problems with their credit history. These loans were risky because of high interest rates, bad credit history, and lack of resources to pay off the loans. Subprime lending includes a variety of credit instruments such as subprime mortgages, subprime car loans, and subprime credit cards. The lenders, however, did not have to worry very much about the risk of default because they rolled these mortgages into bonds called as mortgage-backed securities, which they then sold. They got off risk as these securities were sold to other financial organizations in the form of bonds. Hedge funds at the other end, were always ready to oblige buying off riskiest of these assets even with leverage. Thus, huge investments were being made in such securities. On one hand, the hedge funds were purchasing these assets. On the other hand, they were making huge investment in the stock markets of various emerging countries to provide leverage to these risky investments. But soon, the housing market collapsed and subprime mortgages went under losses. It led to large credit losses. Three big financial institutions failed, that is Lehman Brothers, Fannie Mae and Freddie Mac, and eventually filed for bankruptcy. And soon the panic spread to other institutions. The subprime lenders were affected from both the sides. On one hand, they had a huge list of bankrupt defaulters, and on the other hand, they had the option of hypothecating properties whose value had depreciated immensely. The collapse led to a global loss of confidence as asset prices fell and credit market froze. The Europe was not left insulated from the unfolding of these events. Soon, many big financial organizations such as ABN AMRO, Citi, AIG, etc. started reporting losses. In October 2008, the US government announced rate cuts and issued guarantees for bank lending. The crisis and its effects soon spread to the emerging economies. Money raised all over the world was invested in emerging markets like India and China, and the redemption pressure in one part of the world led to the withdrawal of money invested in other regions, leading to fall in indices across the world. When the subprime market started going down, the hedge funds started receiving margin calls on their investments. This in turn forced hedge funds to liquidate their assets in local and emerging markets, which pushed downward pressure on the stock markets worldwide. The other countries suffered due to the shortage of liquidity faced by US banks and other investors, forcing them to liquidate their holdings worldwide. This not only worsened the trade balance due to excessive capital outflows, but also hit the investors' confidence globally. The meltdown in the financial sector caused loss of confidence and rising uncertainty, leading to falling aggregate demand, a rise in saving, the postponement of planned investment projects, and a running down of inventories. The car sales plummeted. The burst led to tumbling of the fragile blocks in the US economy that not only affected it but also exposed the vulnerability of the integrated globalized world. In a globalized world, it means that the repercussions were limited not only to the US but rippled to the other economies. By the second half of 2008, many developed countries had fallen into recession and many into severe depression. The world trade plummeted and interest rates fell. The development in the US led to changes in investors' behavior. The Europe was severely affected as it had close linkages with the US financial sector and very strong trade effects. The negative effects of crisis were felt in emerging markets and export-oriented Asia-Pacific economies. Demand for the developing countries' exports fell sharply. Japanese export fell by 35% over 2 quarters. The emerging and developing countries that are highly dependent on the foreign investment and financing witnessed a massive flight of capital as foreign and domestic investors withdrew their assets. This had a negative impact on production, business growth, and ultimately hit the pace of economic growth. According to IMF estimates, global GDP had contracted by 2% in 2009. Growth rate sharply declined in the developed countries compared to the developing countries. Some countries, especially in European regions and Central Asia, such as Iceland, Ireland, and Ukraine, were already facing macroeconomic imbalances and fared very poorly in terms of growth rates. The economic crisis had several social consequences also. The most important was a rise in unemployment, falling aggregate demand, and postponement of investment projects forced firms to lay off millions of people. The scope of an expansionary monetary policy was limited as interest rates had already reached zero level, and at the same time it was difficult to expand fiscal expenditure as governments were already running huge budget deficits. The US government has introduced two fiscal stimulus packages to the tune of $1 trillion. Now we will summarize what we have discussed in this module. The East Asian crisis started in Thailand with the collapse of Thai currency Baht. The crisis spread to other East Asian economies: Malaysia, Indonesia, Philippines, Hong Kong, Singapore, and South Korea. Recoveries in the advanced countries led to slowing down of Asian countries' export. The currency crisis and fall in equity prices led to flight of foreign capital from these countries that were hugely dependent on FDI for their development programs. A popular explanation of the crisis is based on the weak economic fundamentals in the form of structural and institutional shortcomings in the East Asian crisis. The US subprime crisis finds its roots in the collapse of the US housing market and accumulation of large-scale debt by the household and financial institutions. Ensuing failure of three biggest US financial institutions led to a global loss of confidence as asset prices fell and credit market froze. The crisis spread to other economies. Europe was adversely affected by the crisis as it had been going through a payment disequilibrium. The meltdown in the financial sector caused loss of confidence and rising uncertainty, leading to falling aggregate demand, a rise in saving, the postponement of planned investment projects, and a running down of inventories, and consequently caused a rise in unemployment.